So the big obvious question that comes up when people are exploring and researching this concept is, what are the costs? So we're going to break down in this video some general ideas about how the cost and pricing is broken down for this concept. So in its simplest terms, we have to understand we are buying insurance. And all insurance is a hedge against some sort of risk. And most of us know to pay for that risk, the insurance company gets money from us that they in turn provide coverage for us on. So if you have auto insurance, you pay a premium every month, and in turn, they give you coverage. You pay your health bill every month. In turn, you get coverage in case something happens. Well, in life insurance, it's the same thing. You're going to be paying what's called a premium, typically every month, but it can also be annually. And that premium is going to buy you coverage as well as something called cash value, which is going to be the accumulation of cash inside of an account. When we pay this premium, the coverage that we're getting in life insurance is actually called death benefit. And death benefit is simply insuring your life, or whoever you're taking the policy out on, their life. And if they were to pass away, this is a one-time lump sum that's going to get paid out to a beneficiary, which is essentially the person that you choose who's going to receive this one-time tax-free lump sum out when you pass away or whoever you're insuring passes away. So in order to pay for that death benefit, that one-time lump sum, the insurance company charges you a premium. That's really, at the end of the day, what you're buying when it comes to these policies. Now, we are taking advantage of some unique structures and components of these policies that allow us to do really creative things. But at the end of the day, we are buying that death benefit. And that death benefit has a cost. Now, that cost can vary significantly. And so what we focus on with our firm is how we can shrink down the overall expense or cost to you and increase the living benefits, or the way that you can use the cash inside the policy while you're alive. Having a death benefit is great for your loved ones and when you pass away, but it doesn't do much for you now. So our entire intention is to focus on minimizing expenses and maximizing cash value, or your availability to use this as a financial tool. So in essence, to talk in really round numbers, when we talk about where money can go in a policy, it can go first to the premium, which is that death benefit, which buys you the death benefit. Or I should say, and it also goes to something called cash value, right? So if we were to contribute $1,000 to a policy, we would want, in a perfect world, the smallest amount to go to the expense and the most amount to go to cash value. Well, the companies that we work with, depending on your age and health rating and how long you're looking to fund it, the best scenario possible is what we call a 10-90 split. Whereas we would want $100 or 10% to go to the expense and the remaining $900 to show up in cash value. That's the perfect world if we're setting this up correctly. Now, it doesn't always work out that way. If you want to fund it for a very long period of time, this split is going to get a little worse, something like 25-75, 20-80, depends on the company and some other scenarios. So the question to ask yourself is, what is the max you want the ability to be able to fund in any given year? So for example, if I want the ability to put in $10,000 per year into a policy, well, then I have to assume that if this is set up correctly, I'm going to be looking at something like $1,000 in premium or expense, with the remaining $9,000 being able to go to cash value. So asking yourself this max ability in any given year is the question that is going to dictate what your actual cost is in terms of premium. So that's piece one. So for part two, we're going to look at what's called an illustration. And this is simply a software that the insurance carriers that we work with provide that allows us to put a series of inputs in this case, if the person is male or female, their age, the amount of money they would like to fund into a policy, and for how long they would like to fund in, as well as their health ratings. And what that ultimately does is it allows them to spit out a projection based on those inputs. So it's going to show you year by year what the costs are that go to the insurance, what the total death benefit is, how that's affected. And it's going to show you the growth on the policy, being that these amounts are guaranteed in the interest that is paid to the policyholder. So it gives you a projection of what's possible. And it's a great way of being able to look at what the best design is based on a person's scenario. So in this case, what I did is I picked a fictitious number out of the air. I just chose a 35-year-old male. And I told the system that they wanted the ability to put in up to $15,000 per year. So going off of part one, where we talked about that split between the premium and the cash value, that would mean that if we look at the top here, this $1,500 is basically the minimum or the premium component of what that would be. If I want the ability to put $15,000 in total per year, the minimum I'm going to have to put in, and the minimum sort of cost in those first few years, is going to be this $1,500 a year. This is the bill I'm going to get every year. So that could be monthly, quarterly, annually. And I'll have the ability to add in an additional $13,500 or $15,000 total. The premium plus the what's called paid up additions, which is essentially the cash that you're going to infuse into the policy if you want to. You can do any amount over and beyond that 1,500 up to 15,000. It could be 5,000 one year, could be the full 15,000, could be 10, any number in between. The point is we have to establish what the max we want the ability to put in any given year. That will then dictate what this lowest premium would be. And in this case, it's a 10-90 split. 10% premium, 90% going to cash value, making up our total annual ability. As we scroll down here, we're going to look at this scenario. And what this is us putting in the $15,000 for a 10-year funding period. So from age 35 to 45. Now, similar to how when you buy a property and you finance it with an amortized loan, like from a bank or a lender, the expenses, the fees, the costs far get front loaded on the policy or the loan itself, right? Same thing happens in the life insurance policies. The costs are all going to be front loaded in the beginning years to pay for that death benefit, like we talked about before. So if you see this net death benefit, $750,000, that is the one-time tax-free lump sum that's going to go to your spouse, your business partner, your children, whoever you deem to receive it when you pass away. So to pay for that, you are paying a premium, in this case, $1,500 per year, to buy you the ability to get the $750,000 lump sum payout. In addition to that, you also get to store up to $15,000 in this policy in any given year. And the advantages of that are all the things you've seen on our channels, where you get the guaranteed growth, you get tax advantages, you're able to leverage it, it's protected from creditors and bankruptcy and those sort of things. And so look at our other videos if you want some reasons why we want to put extra cash in here, but this should give you a good example of what it looks like. So if you look at a couple columns to call out here, the first one is base premium, policy premium. That just means that's the minimum or that expense that we're going to be paying in, that we have to meet in order to put the ability to have $15,000 per year. In this case, we're doing that for 10 years. The next column to look at is really this one right here, cumulative net outlay after tax right here. You'll see in year one, we've paid in $15,000, right? $1,500 to the base premium, $13,500 to cash value. The next column to look at is what says net cash value. This is the real money you have at your disposal, the real account, the equity in this policy. You'll see that number says $13,108. So I paid in $15,000, but I only have $13,000 available, right? So where did that extra cost go? Well, that went to the cost of the insurance. Remember, you're buying that death benefit. So in the first few years here, you're going to see a piece of every dollar that you put in going to the expense of buying the death benefit, the expense of the insurance. Remember, this isn't just a blank bank account, right? To be able to get 4 to 6% guaranteed growth, tax-free advantages, to be able to have protection. It comes at a cost. We store them in these insurance policies, and this is what the cost is. So in those first few years, that's where it's racking up. It's in those going directly to the expense, the premium. Look at year 2. I've paid in $30,000. All right, so $15,000 in year 1, $15,000 in year 2, and I have $28,000 in cash value available. It's about an $1,800 hit. Move on to year 3, $45,000 I put in total, $43,000. So you see this number is getting smaller and smaller, and more is showing up in cash value because you're paying down the expense of the insurance. And as we go out here, if you look at year 4, you'll see that it's $60,000. We're very, very close, or like within $200. And then we hit what's called our break even, which is, in this case, is between years 4 and 5, where I've paid in $75,000 total, $15,000 a year for 5 years, and I have $76,000, almost $700 in cash value. I'm seeing a positive return. This break even is what we really want to pay attention to. We've designed this policy to minimize that expense and maximize cash value in here. If you look at traditional whole life as it's normally structured, and you've probably heard that it's not a great investment, it's because you're not seeing this split. What you're seeing in traditional whole life is for every dollar that you put in premium, you're seeing 0 show up in cash value until it breaks even. So that break even, instead of being between year 4 and 5, in traditional whole life, it's usually between years 15 through 18 or even beyond. So you're waiting and you're paying in, $15,000 a year, $10,000 a year. You're not seeing a dime of it available to you that you can use and access until you hit that break even way out 15 years in the future, where you're only seeing a small amount of it. So we are optimizing these, squeezing down that expense as low as possible, so that you can access this cash at any time. And just to note, when you have that money in cash value, right? I put $15,000 in, $13,000 is available. You have access to that day one that it turns into cash value. It's not like you have to wait until you have it all. As soon as it shows up in cash value, you can loan against it and you can use it for whatever you might want. So the break even is what we want to focus on. So in this example, all we did was put in $15,000 for 5 years to break even. What a lot of people will do to speed up that process is they will put additional money in. They'll put a lump sum in, or they'll put $50,000 a year. They'll pay more in premium, but it'll pay down the expense of the insurance quicker, and it'll make the break even maybe between years 2 and 3 or 3 and 4. And it'll push up the return, the overall performance, because they put more money up front, pays down the loan quicker, and therefore allows them to break even quicker. So moving on from there, if we look at this example, we've only put money in $15,000 for 10 years. So at year 10, we would be age 44, going into year 45, age 45. We've put in $150,000 total, $15,000 per year for 10 years. If we look over our cash value, we're seeing $172,000 show up in cash value, right? So there's $22,000 or so in growth that's been happening there. So that's just what's going to keep happening. That death benefit is going to be there the entire time. And in this example, we never put another dollar in after year 10, right? So maybe we wanted to work, and that's when we wanted to retire at age 45. Or maybe in your case, you only have 5 years until retirement, and you want to reverse engineer that. Or maybe you want to fund this for 20 years, right? Depending on how long you're wanting to fund it, this is where we come in here, and our team would tweak the numbers to make it work. But in terms of the cost, I just want everybody to be aware, you're going to see a negative return in those first couple of years. Even though you have full access to the cash value that does show up, you are playing the long game here. So the money that you're putting in is going towards paying down that death benefit, the cost of the insurance, but you're getting all the advantages of having that accumulation growing, that tax-free as well as guaranteed in this policy. So if we look out, call it at year 20 here, or if we go into like year 25, going all the way out to retirement age at age 65, we stopped funding this policy at year 10, never put another dollar in. We put $150,000 in total, and look at the net cash value, $397,000, right? More than doubled over time just by putting it in this guaranteed account. And so it's really important to be able to look at that. That's the long-term play. You're going to pay the costs in the beginning for those first few years to buy the death benefit, to have that there. But these policy illustrations we put together for all of our clients. So if you're interested in looking at this, that's why it's hard to talk in general terms. You come to us, we sit down, we grab your age, your health rating. We look at how much money you're looking to fund, for how long. We build one of these for you, and we show you specifically everything on this page here is inclusive of all fees, all expenses that go into having this. There's not like there's added fees or anything else. All the math is here. That's why the illustrations are so powerful, because it shows you specifically what you can expect should you put money in for this amount of time. So I hope that's helpful. Please reach out if you have other questions on that. But just know that you're front loading those expenses in the first couple of years until you hit the break even. And then moving forward, you're going to be able to get that guaranteed growth once you're able to put $1 in. And even though I've paid $1,500 in, you're still going to even see that premium show up, right? So every dollar that goes in after break even shows up in cash value, and I get that positive return moving forward.